robust, impressive for the building materials, who usually record peak performance in Q2 because that's when the budget gets released and things like that. But for the other non-industrials, I mean, for the other non-financials like Nestle, like PZ,
DNS
like Unilever, they're all complaining, they're all crying. Unilever, 46% dip year-on-year to May. I mean, sorry, that's PZ.
Okay.
Unilever, about 1.2%. So they're all saying the same thing: weakening consumer demand, weakening consumer purchasing power. Fuel subsidy is actually eating into.
So the population is not helping them right now. 160 million.
Yeah, the population, because you take out you know, the flashpoints across the northern region, then that's actually hurting a large portion of their markets. So it's affecting key supply chains. It's affecting selling. Some of these markets are closing. Kano closes early in the day right now, biggest commercial market in northern Nigeria.
For security reasons.
For security reasons. And you have that across so many parts of the north. So it's affecting them. They're complaining at the same time when the banks are riding on money markets and fixed income instruments. So you're going back to 3-4 years ago when the rest of the economy was saying what's happening to these growth figures, and the banks are actually growing. So there needs to be a holistic, you know, approach to everything. How, on one hand, do you achieve stable exchange rates, and on the other hand, achieve growth and employment?
The one exception is Dangote Sugar, right? Dangote Sugar's long-term fundamentals of the sugar industry is not as robust, just because of competition, and the growth rate is probably unit growth about 5%, and you're getting more and more people coming to that market. But when your raw sugar prices, raw sugar is basically the major input cost. When it's gone down quite a bit, even if it's stable for the rest of this year, Dangote reported 101% growth in earnings in Q1, 80-something% growth in year-on-year in Q2. Now those are fantastic numbers. And if the raw sugar prices remain flat for the rest of this year, you're going to see very strong double-digit growth in earnings for DSR. Now, if you look at the guidance they put out, I think yesterday, they were calling for something similar to, you know, the double-digit year-on-year growth that we were expecting for the rest of the year. So it depends. You have to pick and choose who would you call fantastic or robust.
You can't generalize, because I want to just say a situation where, okay, can we just say a bulk of this, or at least a significant number of them, did well or didn't do well, the non-financials now?
I would say if you ask them generally to tell you how well they've done this year compared to, let's say, 2010 or 2011, this year is would not be on the medal table.
As an analyst, you are the one, you look at the numbers, you do all the analysis, you compare what they made against what they put out as forecasts, you know, before the results come out. So putting their forecast on one hand and what they did, how they performed.
The word is mixed. It's not.
What, neither here nor there for you as an analyst?
It's all right. You know, you can't complain too much when someone's growing, you know, 15%. But if they're growing, they're not declining. But
they're growing at least. Okay, let's come to still on you, Bumi, the bond market. How has the bond market fared at half year? We've seen yields just, you know, going up, coming down. And of course, we have that inflation on the side, 12.9% for the month of July.
Yeah, I mean, coming to this year again, our view was that the fixed income market will not become more attractive. It was attractive, but we felt it wouldn't become more attractive. So if you look at, I do T-bills and bonds. So if you look at T-bill rates, yeah, I mean, take out the last 2 weeks, because those are exceptional numbers. But the yields have come down from about 18-19% to about 14-15%. So on average, you're 15-16%. We'll compare that with the kind of gains we're seeing in the banking sector. And, you know, you can't really compare the two. One stands out way ahead of the other one. The bond market, if you pick the most liquid bonds and you do a very simplistic, let's just check what the prices of how the prices have moved. On average, the 4 bonds have returned flat in 6 months. Now, okay, yes, you know, we've not adjusted for coupons, but even if we put the coupons in, the coupons on average are about 5 to 6%. Well, for the 6 months, right? That is still not that impressive compared to what the equity market has done. So I think, just to pick up on the PFA point, the PFAs are paid to basically diversify, you know, try and take some risk here and there. But if you pile a little of your money into low risk assets, then you're going to get, you know, 15% type annualized return versus the equity market that's done 13%, or a section of the equity market that's done about 40-50%.
Jimmy, let me come to you now. Look, still on the bonds, we have had the before we go on the break, we have had the CBN, the MPC, the Monetary Policy Committee hike the cash reserve requirement for banks. We've seen a lot of cash liquidity being sucked out of the system. Banks have little to play with now, especially at the forex market. Going there to change naira into dollar, that has been curbed a lot. So what has been the direct impact on bonds in that respect?
In the first place, when you say banks ability, it depends on which bank you're talking about, you know. So I doubt if a first bank, if a top three, if a first bank, if a Zenith
or
bank,
what? We should make a distinction between the
exactly,
tier one banks and the
tier ones and the others, you know. So eventually, we believe that would also improve the attractiveness of the bond markets, because the central bank at the end of the day isn't looking at these considerations. The central bank's consideration is exchange rates, the naira, and inflation. And on the exchange rate part, yes, it's the CRR actually may have, you know, impacted on that. Naira is firming up at about 158. But as long as the structural issues which the central bank keeps talking about, the structural issues in the economy, Nigeria is an import-dependent economy. Until we take care of all these long-term issues, you're just going to keep having this fire brigade approach on hiking rates all the time just to face, you know, to fight the naira and defend the naira.
We're talking about the impacts of what the CRR has done in the last. Let me restrict myself to 1 week. We've seen the cost of lending among banks hitting for the 365-day money hitting about 34%. That was obviously a 2-year high. Now, of course, there's been this other issue of the fact that cost of funds, of course, more expensive now. But Bumi was making a point while we're on the break that its net place might not have too much impact on the major net places in the market. Just run us through what it means for the market.
Yeah, at this point in time, if you're a net placer, it means you put more money there.
Okay.
So First Bank, Zenith Bank, like I said, GT Bank, it's a good time for them. And if I were an investor, I would ask myself at this point in time that who's going to benefit from these rates? So I'd rather place my money in banks who are going to benefit from the rates. But I think majorly the issue actually here, for me, beyond cost of funds, is actually confidence gauge. Now, when the NIBOR rate is as high as 34%, then it's actually a major confidence gauge. And for me, that's too high. Some analysts have used words like ruinous for these rates. It's actually a major confidence gauge, but I think it's just too high, especially at a time when small and medium-scale enterprises are actually crying on you know, cost of funds. The World Bank, Nigeria has got its core infrastructural issues. We've got our power challenges. We've got all these structural issues that actually affect businesses. Then now, you now have NIBOR rates as high as 33, 30, 34%. And the central bank's target is all on the exchange rate. By the end of the day, it's going to just lead to a vicious cycle such that if my cost of fund goes up and then the exchange rate even comes down, at the end of the day, everything is going to impact on cost of production in the local economy, such that I may choose to close down production in Nigeria and just import, because cost of production in Nigeria becomes too expensive. And then when I choose to import, that means the demand for dollars would eventually grow up. And if demand for dollar goes up, then you find that the exchange rate is going to, you need more money to fight the naira. So everything is just, you could have a very dangerous vicious cycle if the central bank keeps saying, I want to defend the naira, I want to defend the naira, without realizing that you do not want to defend the naira amongst dead companies.
Interesting. Bumi, let me come to you. It looks like, well, obviously the CBN has said that what it's doing, this recent decision, is all to protect the naira, maintain exchange rate stability. And it looks like reactions have been mixed among financial analysts, and it looks like everybody's giving it their own interpretation. How do you interpret this?
Well, I mean, CBN would want the naira to be stable.
It's its mandate.
Yeah, it's its mandate. Now, I mean, stable could mean, you know, if we know exactly where it's going, so we can plan ahead. That's really what it means. Now, you know, the CBN is not it's not an ideological sort of stance that, you know, we must keep the naira at 160 or whatever. I mean, at the point where they feel that actually, you know what, the market is saying that it should move to 165 or whatever, they'll make the move. They'll allow it to go to 165 or whatever level they feel is appropriate. I mean, because last year that's exactly what happened. So. But the reason why the CBN would try as much as possible to keep that rate stable is because Nigeria is still extremely import dependent, as it was saying, structural imbalances. So if you allow the naira to devalue or depreciate too much or too quickly, then very quickly you're going to basically push up inflation. You know, the cost of basically doing business is going to go up. So the CBN is almost snookered in a way. So
do you think it's been too aggressive,
well,
especially in its fight against inflation?
Well. To be honest, I mean, CBN expected the inflation rates to be much higher than where they are today. So you could argue that, well, actually, you know, given that it's not as high as you expected, maybe it should be easing a little bit. Our view initially was that if the global environment held up a bit better than it is right now, that the CBN would have been easing slightly at the end of this year. Well, that's looking a bit dangerous.